Great. Okay, fantastic. Okay, well, today we're going to discuss what is going on the trading floor at thelazytrader.com. We've got a lot to talk about today. We're going to start off by discussing the trades we're in addition to what is on the watch list, essentially. What is looking good on the horizon for the weeks, days, months ahead. So without further ado, I'm just going to introduce you. Please have a look at the disclaimer. Nothing untowards there, just a quick formality, really. And I'm just going to go on introduce myself. My name's Rob Colville, founder of the used to be a journalist in 2007 and became a financial markets trader by pure accident. I realized after 3 years of being a journalist that it was never going to pay the bills, and I looked on with envy at my friends who were earning a damn sight more than I was in the city of London in their respective professions, whether it was law, accountancy, or even in financial markets. And I thought to myself, well, you know what, I might got average grades at school, but I'm going to give this a go and see how it goes. And I started off my journey in trading. Well, it was a disaster basically when I first started. Made every single mistake in the book several times over, and again times 50. So through my own blood, sweat, and tears, I did eventually, after about 2 years of struggling, gravitate towards a style of trading which matched my personality. Set and forget trading, where I only trade for a few minutes a day. I'll be honest with you, financial markets trading doesn't really interest me that much. I just use it as a vehicle to make money, and I enthusiastically encourage anyone else to do the same rather than use it as an academic bent, so to say. Okay, so it's very important that, for me at least, to follow this whole perspective that we're only on this planet for a very finite amount of time, so you might as well make it count. This is why lazy trading really has to work for me, so that it frees up a lot of time for me to spend with my friends, family, competing hobbies and interests, and as well my beautiful girlfriend also. So without further ado, let's get into the pith of this. For those of you who don't know me, I founded the lazytrader.com brand about 3-4 years ago, back in 2012, and have since been featured on FX Street, Forex PSR, and write regularly for Your Trading Edge, FX Trader Magazine, blah, blah, blah. So I'm going to go to the charts now. I'm going to show you exactly what we're doing in the markets. We've just come out to some pretty decent, juicy trades, and I just want to show you the why and how behind them. I want to talk to you first about gold on the weekly time frame. We just came out of that one. Let me just go back in time so that I can give you a full simulation of how we selected this trade. Okay, so all the way back in October, we saw on the weekly time frame. The weekly time frame is one of my old favorites. I really think that it's so I'm just reading here. Yeah, good. Gold is in a downward trend. Let's not overcomplicate things. We can see this objectively by the fact we've got the 20 moving average below the 50 and the 50 moving average below the 200. We've got lower highs and lower lows. Looking at the cyclicity, yep, the C word. So many of you are probably familiar with this. And you can see it's just ebbing and flowing in the downward trend nice and steadily. Okay, so what we saw was the fact that we had a level or a rejection of dynamic resistance here in the form of the 50 moving average. One test, second test, inside seller bar here. That was our entry point as the completion of an ABCD pattern. ABCD pattern is essentially a harmonic pattern where we've got symmetry here between A, B, retracement, C, D. And it was just an added bonus that we had the completion of this ABCD pattern in what correlated with this dynamic level of resistance here previously tested. So what we did was we took the break of the low of this inside seller bar and we put our stop loss above the high, and we aimed for our first target, the previous swing low here, to take profit 1, and a new lower low to take profit 2. We can see here that we're in a downward trending channel. We've got trend line support 1, 2, 3, 4 tests. So this would be a decent take profit 2, this level here. So the first week we're in the trade, we got triggered into it nice and quickly, and then nice again. It went in our favor, of course. This enabled us to take profit when it matched the previous swing low. Whenever we're trading a trend-based trade, certainly in a downward trend, the previous swing low is generally going to offer a bit of support and therefore an obstacle in the way of a further price reduction or declining price, shall I say. Okay, so we bought back half the position so that we took half the profits off the table. We took a really nice, it was about 5.5% of this one. And then we left half the portion running for a test on this trend line support, might I add. Okay, so We went all the way down again. We tried it for every second seller bar as well to lock in profit along the way. So for those people who like to lock in regular profits, what we did was we simply tried for above the high every second seller bar here, here, above the high of every second seller bar. Didn't have to be consecutive. And then we scaled out. As soon as we got the high low on this test, second test of this trendline support, we decided to take profits because lo and behold, we are looking at, and this is very contrarian, this might not suit you by the way, but I thought I'd share it with you. We're looking at a potential counter trend long in gold. And we've got some evidence in favor of this. And I will say this is not for everyone. I'd always be far rather in favor of the short in a prevailing downward trend. However, on the side of us, for a long, and this is very contrarian, and I do love to talk to people about this, there's always going to be a competing argument for the trade, okay? And I think we've got it. You should never take profit or exit the trade at a point where it's no longer valid. Well, sorry, you should take it at a point where it's no longer valid. And certainly, as we've seen, the first test of this trendline support here, and then we've got the high low test bar, which is a bullish price action based formation, we can reasonably assume that, hey, we're going to get something off this. Okay, we can see that it's making lower highs and lower lows. It's made a lower low here compared to the previous swing low all the way back in July, and of course all the way back in November last year. So is this going to be the higher low in a reversal pattern formation where we're going to see yet another lower high up to this point? Well, there's no guarantees, but the clues are looking pretty good. So I'm going to talk to you about seasonality here. We use a very good little website called equityclock.com. We can see here that from January, let me just drag it over here so you can see exactly what I'm talking about. equityclock.com, this is gold, and this is how it typically fares in January. I know we're only about well, it doesn't time fly, about a week and a half away from January, but look at the bull run typically January gives. Look at it. All throughout January, February, we traced in March, flat, then July, another run. I know last year it kind of contradicted this one, but if we're anticipating this is going to be a retracement in gold to even a lower high, then it will make sense to potentially position ourselves to take profit and make money from a contrarian trade. Like I said, this is a high risk trade. It's certainly far lesser in probability or far lower in probability than if you were to take it short. Of course, I'd love to give you a trade which is with the trend, but we just don't have one. So I'm teaching you to be adaptable with the markets, okay? The market's not going to give us perfect setups the whole time. If it did, then quite frankly, there wouldn't be a market. There's always going to be an opposing view to what side you've decided to take the market. So just building the case for a long low test bar, higher low on a technical level, which has obstructed price from going even lower. Okay, so this is gold. So how are we going to trade this one? If we did decide to go long on this one, well, a classical one would just simply be use the fact that this low test bar on the weekly time frame has acted as a sharp projection of this technical trend line support. We've got seasonality in our favor, and well, I'm not going to say we've got. Sorry, we do have bullish reversal divergence on the RSI as well. For those of you who are not familiar with bullish reversal divergence, it's where we've got higher lows here on the RSI, whereas you've got lower lows on gold. That's a sign to us that the bears are getting weaker in their decline, and we are essentially looking for that as a clue that the bulls are quietly slipping back into the market. Okay, let's see, we've got it on stochastic. We don't, it doesn't matter. One or the other is fine. We use RSI setting 6 and stochastic 833. Okay, so we use one or the other. If one says it and the other doesn't, it's absolutely fine. We'll go with the one that does. All right, so this is gold. We had a fantastic run to the south side selling in gold throughout October. I was in Malaysia back then, and it was a very nice, easy setup to get trade, which is just as well because I was selling myself in Bali and then went to Penang, and I didn't really give a damn what the markets were doing. Quite frankly, I knew that my positions were with the trend and making money. So now with Christmas time just around the corner, I'm looking for the case for, and I found the case for contrarian long for gold, okay? But I accept the fact that it's far lower in probability. So a conservative way of trading this one, bearing in mind it's a higher risk play, it would be to simply place an order to go long at the break of last week's high, stop loss below the low, and then if we do get triggered into the trade, we'll trade it above the low of every second buyer bar, okay? And until we get stopped out. So that's how we're going to play it. If you wanted to be aggressive, very aggressive with it, what you could do is place your order above the high of last week and put your stop loss above this week's low round about here. Okay, but that's higher risk, and I can assure you this kind of style of trading is not for everyone. All right, so that's gold. There are other trades on the horizon which I want to talk to you about. Okay, I don't want to just chat my way through gold when there's plenty of others I want to talk to you about. The FTSE, turn to the indices just very briefly. We're anticipating the Santa Claus rally. Typically, this time of year, the equities are on a climb. Everyone's on a seasonal high and looking to essentially impose their joy and hubris onto the market in the form of buying. I'm a little bit wary this year because we look on the FTSE on the monthly, we can see here that actually for the past 20 years, we've just been range bound here, zigzagging in this range. And as we met the all-time highs of the FTSE all the way back Easter time this year, it looks like we're just on the verge of going all the way down to the bottom again. The markets crash every 5 to 7 years, and we're certainly overdue for one. And I haven't seen a technical excuse for a long or FTSE yet. So I'm staying clear of this. Okay, it's one thing to have seasonals in your favor, like the Santa Claus rally, like of gold, but we do need a technical reason to get into the trade. That is the very important thing that a lot of people miss. I was staggered, shocked and stunned and angered by a client the other day who said, well, I read in the newspaper that equities typically go long at Christmas time, so I'm just going to place long on my IG index account and just not look back. And I said, please don't be silly. Why don't you just find a technical level? And I spent half an hour talking to him about technical levels, and I think he got it, but I do worry about him. Anyway, moving on. So that's the stance on the FTSE at the moment. Yeah, we're sure we're due for a bull run in the lead up to Christmas, but technically it's looking pretty shaky, and I don't like the look of it on the monthly or the weekly, or in fact the daily for that matter as well. So let's move on to something a little bit more cheery. I want to talk to you about pound Swiss, which is a trade we're in, and we're making a huge percentage returns on this one, and I just want to share the setup with you so that if we get a similar setup in future, regardless of what the currency, asset class or whatever it is, you can do the same thing. With the pound Swiss, I don't really care what the currency pair is, by the way. I trade anything as long as I see a technical argument behind it. You see this multi-year high here, this staunchly strong level of resistance. You can see, looking in the weekly, just to emphasize the point, that this level has not broken for quite some time. Since 2011, and it's held. Well, it's been range bound, actually, pound Swiss, ever since 2011, and we've had a ricochet off this level, 1.550, just earlier this year. So let's go back down to the daily, because this is exactly what we're looking at, or what we traded it off. So here, we've got this extension into this multi-year high. We had the first rejection of this level here. The more aggressive traders who trade our power zone strategies would have simply gotten at the market on the level. That I know that's not for everyone. People who want to trade the third entry, which is in our reversal strategy, will typically wait for a lower high of this multi-year high, characterized by bearish pin bar reversal if it's off a level of resistance. So we had the lower high here. And what we did was we placed an order to go short below the low of this bearish pin bar reversal, stop loss above the high, in anticipation of a break to the downside. The fact that we've made a lower high of this level indicates that there is now momentum to the downside. The bulls have been trounced by the bears. The bulls have not been allowed to exceed or even match the previous high here made towards the end of November. They've just been allowed to go thus far. And the fact that we have had the previous to this bearish pin bar reversal 1, 2, 3, 4, 5 days where the low is not broken of the previous 5 days is a real testament to the fact that if we were triggered into the trade here for a reversal short, that would be a significant event. Okay, so entry just below the low, stop loss above the high, and then we got our move to the downside. I know this was perpetuated by news, but do we even care about news in long-term trading? No, and I've done webinars on this before, because if we've got high reward potential behind the trade and the news outcome could be 50-50 in the trade's favor or not, then at least we know full well that if the news doesn't go in our favor, then all we stand to lose is 1 or 2% or however much we've risked. And if it does go in our favor, then at least we've got a shed load of percentage points and pips to be made. So here we go. We're in this trade at the moment. We've made about 1, 2, 3, 4, 5, 6, between 13 and 15% on this one, and we've got plenty more downside to take advantage of. for this one as well. So we're quite happy with pound Swiss, and may the pound weaken further against the Swiss franc, because well, it's good for us, and it's certainly good if we're buying online. So, or not, as the case might be. So here we go. We've got the market here. We've got several levels in the way. We've got this level here, and we've got this level here. What we're waiting to do is, given the fact that we take a macro perspective, you'll see a sharp projection at this multi-year low here. There we go. You can see how quickly the market was to reject this one spot 1,500, and we entered here. We're round about here. So what we're going to do is potentially look to scale out. Our first scale out will be at this point here to bank half the profits, and wait for price to come down here just above 1 spot 400. If it does, great. Then we'll look to obviously scale out again and leave a fraction of our trade running. So if it comes, excuse me, I've just been sneezing, all the way down to here, then we'd look to, be in the trade still. And of course, we would be doing that, banking profits along the way. And of course, keeping ourselves in the game. That's the important thing to do. If you're in a winning trade and you essentially have a lot of percentage points or pips in your favor, and you're with the trend or with the overall move, then why kill it completely? Okay. If you're surfing a wave or riding a wave, why do you want to jump off midway through? I say, of course, there's a trade-off between looking at banking profits and, of course, mitigating downside and keeping in the trade. But that does depend on what kind of a trader you are. If you wanted a high probability, low order outcome, you take profit right now with this pound Swiss short and have the added bonus of, hey, I've made a bit of money here. I want a high probability and get out of a relatively small reward. But that's what you pay for. If you want a high probability outcome, you get a smaller reward. Versus if you want a lower probability outcome, but you want a higher reward for that, then typically you'd stay in the game for a little bit longer. Bearing in mind, the interest rate in Switzerland is higher than it is in the United Kingdom, so the rollover overnight rate will be in your favor. So you'll be making money all by fraction every night this rolls over, if it's a cash daily rolling brokerage account, like at market, direct market, should I say. Okay, so in terms of trade ideas, well, what I'm simply waiting to do in the meantime is sell the rally in this downward trend. I'm waiting for the dead cross with the moving averages. We've still got a little way to go for the 20 to cross below the 200 and of course the 50 as well. But buying the dip in an upward trend or selling the rally in a downward trend is key to any trend trader's success. And of course, you can get trends within ranges. Look, we had a trend to the upside in this range, and we're looking for a potential trend to the downside. Okay, so I'm going to move on to another trade idea. I want to talk to you about EuroCAD here, and this is an interesting one for those people who've got, dare I say, a high level of testicular fortitude, because let's scale on the weekly. We do have a decent trend setup here. We've got a very strong level of resistance here. There we go. It's held since 2009. We've got the rejection just here, just at 1 spot 5,500. And what we're going to wait to do is wait for a potential reversal against, well, at this point, depending on your risk appetite, your entry for the reversal is going to differ. Okay, for those people who are higher risk and happy to receive a potentially higher reward, but in exchange for the high risk, the old adage, where there's risk, there's reward, will simply trade this as a power zone short, and they had their order to sell on the level here with their stop loss 50 to 150 pips away. So between here or here, I would recommend between 100 and 150, quite frankly, just in case there's a false breakout, and would wait for it to turn around. If they get a close above the level and the next bar takes out the high, then the setup will be invalidated. For those people who want to be a little bit more cautious, then recommend waiting for a price action based setup at this horizontal level in the form of a bearish pin bar reversal with bearish reversal divergence and or a reversal pattern on the smaller time frame. That's another way you can trade that, slightly lower risk, and you've got the extra confirmation there of waiting for a price action based setup. Or the third option would be for an even safer entry and wait for something which exactly the same thing as we just talked about for pound Swiss, waiting for the first rejection on this level and a lower high on the level as well. And we wouldn't trade it until we got the lower high rejecting the level, and the lower high will be characterized in the form of a bearish pin bar reversal of the level. Okay, so that is essentially what we're waiting for on this one. And that's it. Very straightforward, simple stuff. But a lot of people, the old adage, trading is made, it's very simple, but it's made complicated by idiots. And if you can find simplicity in your trading, I can quite easily find simplicity on the weekly and the daily time frame. It's very peaceful. I don't have to listen to the news or spend an undue amount of time meddling, fiddling, or getting paranoid about my trades. I've got a plan for where I'm going to place the trade, what I'm going to do if it goes wrong, and in addition to what it's going to do if it goes in my favor. All right, so that's the way of trading the daily and the weekly. They're also immune to a lot of news announcements as well. Let me talk to your notes. Old news and everything, but dollar strength still prevails, especially against the South African rand. I mean, look at this. This is ridiculous. It's still valid. I mean, you've got great order angular separation between the 20, the 50, and the 200 moving averages. Very nice and straightforward. You can see they're facing towards 1 o'clock if you imagine the imaginary clock face. And you can just see that there's great interaction with the 20 moving average. You've got 1, 2, 3, 4, 5, 6, 7, 8 previous tests, trend line support here. So all we're waiting for is, lo and behold, a retracement to the 20 moving average, as it's been tested so many times before. What's to say that it's not going to test again and go up after kissing the 20 moving average as and when? So this is on our watch list for that very reason. I'm just looking to buy the dip in an upward trend. Nothing outrageously complex about that. Let's talk about dollar sec now. This is slightly different. We've got an upward trending market, as characterized by the order angular separation of the 20, the 50, and the 200. And we're in this range here. Some people might see this as the market breathing in before another punch to the upside. Another group of people might see this as a triple top reversal. It doesn't really matter what way you look at it. The fact of the matter is if we see the market come down to this level of support, we'd look to buy. It's a zone of demand. If we wait for the market to come up to this level of resistance, it's a zone of supply, so we'd look to sell. So we'll trade this in exactly the same way as the previous trades, as power zones. Okay, so what you can do, as if and when price comes, you can do it on the daily or the weekly, it's up to you. If you want it to be aggressive and price comes down to this horizontal level here, you'd look to buy if your stop loss 50 to 150 pips away. Or if the market comes out to this level of resistance, a zone of supply, then you would potentially look to sell on the level or just below it with your stop loss 50 to 150 pips away, just in case. Of course, if you want it to be a little bit safer, you can wait for a bearish pin bar reversal to form off this level of resistance. And if you want to be even more careful, you would wait for a lower high of this level of resistance, just like we saw with the pound Swiss trade, which we talked about and we're currently in. Conversely, if as and when price comes down to this level of support, this floor here, it'll give us a decent buying opportunity. Those people who want to be a little bit more cautious, so let me just move this here. Line shouldn't be down there, it should be up here. Wait for a buy off this level. The aggressive trader will typically have an order to buy just on or above 8 spot 100, stop loss below the level where it's faked out before here, or 50 to 100 pips away. Those people who want to be more conservative, and that's understandable, everyone's different, then they would look to buy after a price action based reversal of this horizontal level. It could be a bullish pin bar reversal, it could be a double inside bar, or if you want to be ultra or even more careful, then you could simply have a higher low, a formation off this level of support as well. So that's dollar sec on the watch list for that very reason. Okay, so anything like, let's look at dollar CAD, for example. I mean, this is just on steroids at the moment. Any dollar-based pair, I mean, like I said, it's no secret that the dollar is on steroids and it's bullish, of course, amid interest rate hikes potentially next year. Regardless of that, it's a reflection on the economy as well. Of course, what we're going to do, we're not going to pick tops or bottoms of dollar CAD, especially when we've got the order angular separation, 20 above the 50, 50 above the 200, all angling towards 12 to 2 p.m. We're just going to wait for price action to pull back and buy dips. Okay, that's the easy thing to do. Just wait for a retracement price to go down before the market surges up again. Buying dips in an upward trend and selling rallies in a downward trend, that's the secret, really. And a lot of people overcomplicate this. Like I said, folks, trading does not have to be difficult. It really doesn't. But for some reason, we do make it difficult for ourselves because we feel that to make money from the markets, we need to work hard. It doesn't have to be that way. And trust me, I've traded and tried every system under the planet, and I've always come back to end of day trading as my bread and butter, and that's all I'm really interested in, because of its lifestyle benefits. I don't want to be in front of the screen all day chasing a few pips, talking shop about pivot points and intraday spikes and scalping. Not interested. It's stressful. I'm pretty lazy. I'm dyspraxic as well. I've got a very short attention span. And of course, I didn't know that at the time of my school years where I could have got extra time for my exams. But hey, I know it now. And I found a style of trading which works for me and works for anyone, in my opinion, who just wants to make money from the markets rather than talking shop about the markets. Now, speaking to one of our mentors who works for the Lazy Trader, and he's had 25 years experience in the market, and I was staggered to find out from his experience that through his networking with people and clients of his before he came to work for us, that a lot of people just trade financial markets, not for the financial gains, but just to talk shop because it sounds impressive. And it's interesting to hear that. I've been in situations before where I've told people a perfect place to enter gold or a trade idea which had high profit potential, and okay, it wasn't guaranteed, but people wouldn't trade it. They just wanted to talk shop about the market. Okay, I've got a question from Rick. Thank you, Rick. So what's your strategy behind success? I would say that's a great question, and I would say the main thing is patience and discipline. Just manage your expectation when it comes to trading. Do not, for the love of God, do not think that more time in front of screen equals more success. Do not think more trades placed equals more success. Sure, it's a learning curve and you'll make mistakes through doing this, but I would say trading, for it to work properly, ultimately has to work with your lifestyle, and it has to be a peaceful and carefree activity. The amount of people I've met through mentoring who start off trading and they say they want to be a full-time trader, and I ask them how big their trading account is. They say it's $1,000. If you think about it realistically, Warren Buffett makes 20% a year on his investments, which is a fantastic return consistently, but he's got a multi-billion pound fund. If you think about it, a $1,000, £1,000 trading account, 20% on that per year is a great return, regardless of how big or how small it is. All right, so 1,000, 20% of 1,000 is 200. How is anyone going to live off £200 or dollars a year from someone being a full-time trader, even though 20% is a fantastic return? It's just not feasible. This is why I always say to people, keep your day job. Don't be ridiculous. Don't have these grand illusions before you become consistent, okay? I don't want to trample on anyone's dreams. Anyone can be trained in trading, no doubt about it. But I know it sounds very boring and very inconvenient, and I hated to find this out when I was new to financial markets. It is a game of the tortoise and the hare. You're willing to take a slower route to mastering the markets and accept that mistakes will be made invariably. But if you start off with a smaller size account and just take it from there rather than going in all guns blazing, then you'll have far quicker success. It took me 2 years, and I made every single mistake in the book. A lot of my clients, well, it varies. It's up to them ultimately. I mentor people who get it within a few mentoring sessions. I have people who just won't follow any advice, and they'll just, funnily enough, people who are slightly older in age and got slightly higher up in the corporate ladder as well. I think there might be a bit of imported arrogance behind it. I don't know. But anyway, so let's see. Another question here. I'm going to deal with the questions at the end. Forgive me. I just got a couple more bits to talk to you about, okay? I had a couple of questions earlier today about, this is a funny one, US dollar versus the Hong Kong. This one, it looks like a bit of a mess, doesn't it? But it's on the chart, so some of you might be familiar with this one. And as the US dollar and the Hong Kong dollar are pegged, of course, it's going to have this floor here. And, by and large, a popular way of dealing with this would be to simply buy the floor here at this horizontal level, stop loss below a point where it's been faked out before, and take it to the top. Well, it's up to you, but quite frankly, this looks pretty disgusting, because the spread offered by a broker, because it's such a high probability play, to an extent, off the level, is very likely it's going to go up by a certain number of points. The last time I checked the spread, it was 12 points. So if you bought it on this level here, it will be, you'll make money until it goes this much in your favor. And if you bought it on the level, it hasn't gone more than this much in your favor for, well, ever since September, really. So you could find yourself trapped in this trade. And only on one random cold winter's day, you'll find it either spiky in your favor, and then you might not even be in front of your charts to collect the money unless you set a limit order, or they might remove the floor like the Swiss National Bank did rather memorably back in January, and that caused shockwaves throughout institutions, brokerages, loads of retail traders as well. A lot of companies went bankrupt actually as a result of that. So we'll see what happens with this. So I'd recommend, okay, it's a valid play off a level that is being defended by a central bank, but if that level is no longer defended, you will see the market absolutely collapse, and I can rest assured your broker won't be too quick in getting you out of that, because they'll have so many orders to fill. Okay, they can only do their best. All right, so moving on here, let me move on to this one here. This is Aussie New Zealand. This is a funny old currency pair. It's been good to us in the past. Lo and behold, this, well, some people can read this as an inverse head and shoulders pattern here. It doesn't really matter if it is or if it isn't. The fact of the matter is this could potentially be a high low of the right hand shoulder, which could form. We've got the left hand shoulder, the head, and the right hand shoulder. So if we do get a high low formation of this horizontal level, then it could potentially be a decent place to go long. Okay. That's one other trade idea. You can generally see the overall theme here. If you want a multi-year high or low, it makes sense to place your orders on the level. If you want to be aggressive, if you want to be conservative, wait for a price action based formation, or if you want to be even more conservative in a trade reversal, then you wait for a lower high if you're going short, or higher low if you're looking to go long. If you're trading with the trend, it makes sense to simply buy the dip in an upward trend, or to sell the rally in a downward trend. Okay, so that's the overall premise from this. I can give you trade ideas. This is what I'm doing right now. Okay, so this is dollar yen, another one. This is struggling at the moment. We can see, okay, hesitation. We've been climbing for such a long time. Let's go back in history. Wow, yeah, we really are at multi. I haven't really looked at this currency pair at length since forever, actually. I'm not really a fan of it. There's no real reason why I shouldn't be a fan of it. I just haven't really seen that many entries on the smaller time frames yet. I want to say smaller, I mean the daily. Okay, so let's see here. This is hesitation before potential push to the upside. Remember, the whole world is long on dollar, and there's going to be profit taking at technical levels. So we can see here as either hesitation before break to the upside, or a potential reversal. Either way, the reward to risk is potentially in our favor. So I'd look to go long if it gets down to this level here, and I get a bullish pin bar reversal underpinned by a reversal on a smaller time frame. Or I could look to go short if, as and when it goes up to this level here. I'd rather go long because the overall bias in the market is long as well. Okay, so let's look for some more trades to potentially go long or short on. Pound NOK. This is a good one. Let's look on the weekly time frame. Or even pound Aussie. Sorry, I forgot about this one. I wanted to talk to you about pound Aussie. Yep, so once again, we've got the 20 above the 50 above the 200. It makes sense to simply buy the dip in this upward trending market on the weekly. We can see we've got good cyclicity, higher highs and higher lows all the way up. And we just simply waited to buy the pullback. We see that it's tested the 50 moving average that it has here. So we're just waiting for a high low bullish pin bar reversal off this before going long. Okay, so like I said, further proof of the pudding that it makes sense to buy dips in an upward trend. Okay, so that is essentially it for now. We've got a few trade ideas. I've discussed what trades we're in. We don't trade that many trades per month, but the trades we do take are high in profit potential, and we only risk maximum 2% per trade. We're very happy having periods of time where we're not trading if there's no technical setup, but we are looking at potentially adding to the position for pound Swiss
We're short, already made a decent amount on that, but we're looking to simply sell the rally. We're looking to potentially go long on gold. And what else? Sell Euro CAD, thanks to the level here. And of course, I think Euro Aussie. Let me think. My mind's getting a bit shaky. I've been rushing around dealing with Christmas shopping, and Oxford Street is a nightmare, and every other Tom, Dick, and Harry are doing the same thing as me. I've left it too late again. Anyway, so here we go. Okay, this is a pretty nasty looking chart. On the weekly, let's just say it's very jagged. Let's just say buy the dip on this on the weekly time frame. Essentially, these currency pairs are a two-horse race. Euro dollar, thank you. That's someone who's asked me that. Well, euro dollar, it's still bearish. I mean, Eurozone, I mean, goodness, less I say about better, really, but we're still south, 20 below the 50, 50 below the 200, and we just had a breakout of this symmetrical triangle, and we're just waiting for, oh, it looks very ugly, actually. I mean, I don't have a view at the moment on euro dollar. Fundamentally, it's bearish. Technically, it's just moving sideways, and it's been moving sideways in this box for a long time. One thing I want to share with you is Euro GBP. This is one which is slightly more interesting than euro dollar and cable. You can see that we've been going down on Euro GBP ever since 2009, and we've been hesitating, typically at this time of year. So last year, 2014, we can see here that we had on the weekly time frame, we had this rectangular box here forming, and we finally had the box give way. And what happened was that price fell into another box. Like so. There we go. So what we did was, a few months ago, what we did was we sold at the top of this rectangular box here, this hammer, entry below the low, stop was above the high, first target, previous swing low, and we looked, bagged ourselves a good 2-to-1 here, and we just scaled out, of course. And what we've got here is potentially coming up to do the same thing again. So what we're waiting for is to do exactly the same thing at this technical level. Sell, my apologies, what am I talking about? Buy. Sell here, bearish pin bar reversal on weekly or daily, underpinned with a reversal on a smaller time frame and or bearish reversal diverges, because quite frankly, it's happened time and again. Last year we had this rectangular box, and eventually the level of support gave way until we formed this new box here, where we've had oscillation between the level of support and resistance, and the high here, basically, we're waiting for it to interact with until we get a sell set up. And essentially, if we do get triggered into that trade, it'll be great, because it means that we can make money and be well and truly nested into this bigger, longer term, a bigger picture move, if, as and when this level of support does give way and we do break into a new box or consolidation. Okay, as technical traders, we are waiting for the market to repeat itself. We've seen two recurring nuances here. We've got here this box followed by this box, or rectangular, should I say, and we've had the breakout, so we're waiting for the breakout again here. So we can position ourselves at the top of the box before it potentially turns around and goes down again and makes a new lower low. Then we can do very handsomely or very well from this. Okay, so that is Euro GBP. We've got a nice stocking full of trade ideas. We've got gold, Euro GBP. Sorry, it's been such a long day. Euro CAD, pound Swiss. So you've got plenty to go away with. So I just want to talk to you very quickly about something. If this style of trading does appeal to you, then we can definitely help long term. Certainly any New Year's resolutions or any Christmas presents you might have in mind for yourself or anyone else. Our specialism is to transform what is essentially a stressful, expensive mistake into a carefree and relaxing hobby from as little as minutes a day. So what I want to do is really kind of like offer you the opportunity to have your money working for you. And what we're doing is we're teamed up with FX Street to give you this Christmas special. It's only valid until tonight, midnight, by the way. I repeat, it's only valid until midnight, tonight, then it's over. And it's access to our ultimate program. It is valued at $1,997 US. But what we're going to do is give you a test drive for $30. to see what you think. It might be for you, it might not be, but for this, you'll get access to all of our strategies, all of our trade ideas, weekly market analysis, contributing traders, pattern recognition software. We've even got a trader hypnosis audio course and forums, and it's a guarantee. So if you're not 100% happy, we'll just give you a full refund. Absolutely no problem. Okay, so to get this stupidly big discount valid until midnight tonight, then all you need to do is go to thelazytrader.com / training, buy the ultimate program, read the terms, and use the promo code FXStreet, and then you'll get your discount. Okay, 88% discount is not bad. Like I said, it might not be for you. If it's not, we'll just give you your money back, no problem. Okay, but you've got nothing to lose from this. All right, so hopefully see you on the other side. Whilst you mull over whether it's for you or not, I'm going to talk to you about, well, you've kindly asked me some good questions here. Here we go. Let's see. Rick, again, I know all the theory by books, but when it comes to applying on the chart, I pull the trigger. I am lost. I use Ikimocho. Okay, well, the purpose of this webinar is not talking about Ikimocho, but I will say there's no substitute for actually being in the market. Okay, a lot of hedge funds and trading floors out there, they'll have analysts and traders. They'll do very different things. The analysts will not trade, they'll analyze, and the traders will not analyze, they'll trade, but they work together. Okay. I know people who know all the theory and every strategy from books under the sun, but they can't trade to save their lives. Okay. So I would say it's great to have an awareness and an appreciation for the psychology and the wider discipline of the market. But I would say just, unless you're consistent, use a demo account or a smaller trading account so that you can go for the emotional rigmarole of making and losing money. Okay, so I would, well, if you are lost, then may I invite you to come aboard our ultimate program. We could be able to help you, Rick. So yeah, that's some food for thought for you. Another good question here is, how many trades do I take per month on average with your higher time frame strategy? Well, that does vary according to the month. Some months we take between 2 and 6. Other months we take between 1 and 3. It really does vary. Trade setups and winning trades and losing trades are like buses in London. You might be waiting a long time for a setup, regardless of whether it's a losing or winning outcome, or they might all turn up at once. October was a mere veritable famine in the market for setups, but certainly our patience paid off because we've been given not only a gold Euro GBP short and also our pound Swiss short, which came home to make fantastic gains for the quarter. We are positioning ourselves for more trades in the future, like the gold long and Euro GBP short yet again. That currency pair has been good to us, so it's absolutely fine. You know, the time money link in the market is broken. The returns you make are not reliant on how much time you spend in front of the screen. That's why I set and forget. I make more money, ironically, from the markets, not doing much and pursuing hobbies than I ever did, intraday trading. And there's no reason why you can't do it. I'm not particularly good at maths. I'm not particularly a fast learner. And I'm certainly, according to my teachers, a C grade student at school back in the day. So, you know, anyone could do it, providing you're happy and to be patient and disciplined. And of course, treat it, go the longer route rather than all guns blazing. Okay, so good one from Jest. Are you willing to risk more on the higher time frame than a lower time frame, or do you risk the same amount regardless of the time frame you're trading on? Well, good question. I risk the same regardless, Jess. Yeah, hope that answers your question. Thank you. That's a good one. And my view on euro dollar, I've just told you that view on euro dollar. And yeah, so any more questions, please do ask. Thank you all very much. Have a fantastic Christmas, and I look forward to seeing you in January. If you like the look of the Ultimate Program, maybe I'll see you before that. Okay, happy Christmas and a happy New Year as well.